My next guest says the only things that can bring prices down now are removing sanctions or having a recession induced by demand destruction. Joining me now is Bob McNally, founder and president of the Rapidan Energy Group and a former energy advisor to President George W. Bush. Bob, it's good to have you here. Does demand destruction have to involve a recession?
I'm afraid it does. You know, oil demand is the lifeblood of a modern economy. It's not a discretionary good. It's not movie tickets or cigars that we can just go without if they get pricey. So it's required for us to get to work. It's required for factories to work and so forth. So these types of energy shocks usually are at the scene of every recession. And I'm afraid it might have to be the same way again.
Although even the last big one in 2008 happened as the financial crisis was already in motion. There were a lot of things that really pulled down the economy. And I just wonder if this time's different because you have consumers with a lot more sort of pent up spending power. Gas prices are not anywhere near where they were in 2008 in real terms. And so are we necessarily going to see something that's 2% of household spending send the consumer into a recession?
Well, we're going to find out, I'm afraid. We may have to go to 3 or 4%. At Rapidan, we expect crude oil prices to start causing macroeconomic pain around $150 a barrel. So we have a ways to go. But, you know, as you know well, we're coming out of COVID. Central banks are raising rates. We have a huge debt burden, all kinds of uncertainty. So it's not like it's a smooth sailing economy, you know, in which we're facing these kind of energy price increases.
Yeah, and I know that it isn't, you know, sort of your job to make the policy response, but there has been some talk about how the U.S. has seen a tool for lowering our energy usage. It was called stay at home during the worst of COVID. The irony is nobody wants to do that again. So I'm curious what you think the message should be to Americans who are facing sticker shock. Should it be to try to use less, or should it be, no, hey, get out there, we're reopening, everyone's excited to travel and drive and see people again? It's a very difficult time for this all to be coming to a head.
You know, it's a very difficult time, and I'm glad I'm not in the White House right now. I was there after 9/11. I've been there for crises and high oil prices. There's really no good message at this point. Wear a sweater, don't drive. That's not going to work. No, America has to reopen after COVID. What I think we have to do, though, the Biden administration has to be more successful at convincing folks that they're not out to crater Russian oil exports, especially. Russia's the largest crude oil and product exporter in the world. Without those exports, as long as there's a fear, and that's the issue here, is a fear that we're going to go and try and block all those exports, the economy is heading towards a recession. So I don't know that we need messages for the American people so much as leadership in the White House.
So let's run through the numbers for a second. My understanding there's about 6 million barrels a day of Russian oil, seaborne oil and exports and that sort of thing that are potentially at risk here. Although, again, this is just the U.S. move. So how much needs to come online to replace those Russian barrels right now, and where's that going to come from?
Right. So really, Russia exports almost 8 million barrels a day, about 5 million barrels a day of crude oil, and then almost 3 million barrels a day of refined product. But let's just talk about crude oil. We have a 5 million barrel a day problem, and a good chunk of that is starting to stop already, even though the Biden administration doesn't want to see that happen. Shippers, especially at the seaports, they're not picking up the Russian crude. But let's just talk about offsets. 5 million barrels a day is the problem. Inventories are low, so we're not going to draw those down much more. OPEC Plus could probably drop in half of that, mainly in Saudi Arabia and UAE, but they're not doing that, or they're not doing it at a fast enough speed. You sign an Iran deal, maybe you get another million barrels a day in a few months starting after that. That would help. Venezuela, a few 100,000 barrels a day in a few months if you ease sanctions. So with inventories low, supply demand tight, the problem is you have a 5 million barrel a day risk, and you don't have 5 million barrels a day to quickly bring on to offset that. That's why prices have to do their terrible work and enforce consumption.
Shepard Smith here. Thanks for watching CNBC on YouTube.